All right, folks, I wanted to do a quick analysis on how I arrived to a $2,910 price target on Amazon using simply technical analysis. So what you're seeing right here is the chart price of Amazon, but most specifically focusing on the price action of the last week and a half, okay? There is some principles and methodologies that I'm applying to arrive to the $2,910 price target. And I'm going to explain that to you so that you can have a better understanding of my thought process and how I apply chart analysis to come up with this. So the first thing is understanding technical analysis. And one of the methodologies or one of the principles is Gartley pattern. So Amazon technical analysis. Okay. And the specific methodology or analysis that we're going to be applying is Gartley pattern. And forgive me if I misspell the word Gartley. And what you need to understand from a principle perspective about Gartley patterns is that stocks behave in waves or patterns. In this particular case, going on the downside is that your first wave, your first measure move, okay, follows a temporary bounce or a dead cat bounce, and then it resumes is continuation to the downside. So you have your first wave, which is from point A to point B. You have your pullback or your temporary bounce, point B to C. And then you have your continuation to the downside, point C to D. A very simplistic formula for you to understand this, and we can apply to any other case studies or any other examples, is that your A to B wave, wave number one, equals your C to D wave, wave number two. So how do we apply this principle to Amazon stock price, where we ended up projecting $2,910 price target for this upcoming week? Okay, so let's look at it here. Okay, let's get a clean chart. So your first point, okay, it's over here. This is the change in direction. This is your A point. The swing low right here, where it reverses, this is your B point, your temporary bounce. Your high of this reversal is your C point. And now we're projecting what your D point move is, or your projected price target. So let me draw here the example, your A to B, your temporary bounce, B to C, and now we're trying to calculate your C to D move. And of course, at point B, this acts as support. Support being there are buyers, there are people waiting for a bounce at this point, because at the B point, it bounced the first time. So sometimes you get some traders buying this support point in anticipation of a move to the upside. But statistically speaking, the chances of the stock going from C to D is 70 to 80%. So now we have a statistical probability chance that it's going to play out in this fashion 70 to 80% of the time. So if I revert back to my initial graph, which is this one, okay, you can see here basically all of the price points and how we applied this Gartley pattern. So my point A is 35.52, right? 35.52. This was the high. This is A point. The B point, it's down here, was $3,113. Then my C point, okay, is 33.49. Now, what is the expected D move? So how do we solve for this? So the way we solve it is by calculating the difference between point A to B. That difference is $439. This move represents a 12% decline on Amazon stock 2 weeks ago, creating the first leg, A to B. Then we get a temporary bounce. This is a sucker's rally, a dead cat bounce, and now is setting up to continue to the downside achieving or meeting its projected move of 29.10. So once you have the difference between A to C, you're going to take your point C, I should have said A to B. You're going to take your C point, which is 33.49, right here, 33.49, and you're going to subtract the 339 minus, I should say 439, and your actual price becomes your price target, 29.10, and that's where we got this right here. Now, from a probability standpoint, you can see right here, 70 to 80%. That C to D will happen. This is another 12% to the downside. Now, obviously, it's very hard to get the exact swing points on this from a trading perspective. But if on Monday, if you take this trade at the close, right? So this is Friday's close right here, this red candle. This is Friday's move. If you take the trade at 31.16, provided that the market opens and you could short it at this price level, you still have a downward move of 6% that you can capitalize on. So how is this applicable in the real world? How do we apply this with a trading account? Well, let's say that you have a $1,000 investment account and you place this trade, okay, and you're expected to make 6%. So on $1,000, multiply that by 6%, you're making $60 profit, okay? And the chances of you making $60 is 70 to 80%, statistically speaking. So the odds are in your favor. Will you take this trade? And of course, nothing is absolute. There is still a 20 to 30% probability that this trade won't work out, that this bet won't pay you out. So you could potentially risk 1%. So risk 1% of your entire equity on $1,000 portfolio. You're risking really $10. So you're risking $10 to make $60. That's a really good payout. It's a really good payout. So will you take this trade provided that you have a 70 to 80% probability? Now, this is what I'm anticipating for next week. I am anticipating a $2,910 price target. And the way I'm going to play it is through options. So if on Monday, if the stock breaks this swing point, if the stock actually begins to move lower on Monday, I'm going to play it through the option size. I'm going to buy option where the payout could be 10 to 20 times. What do I mean by that? In the options world, okay, the payout for this type of trade, I'm looking from 10 to 20 times, which means if I risk 1% of my capital or $10, my potential payout could be anywhere between $100 to $200. This represents 10% to 20% return on investment on your entire $1,000 portfolio. This is a good payout. But what's important here is to understand the process of how we came up with $2,910. Let me know what you think about this analysis. Let me know if this is clear, if you understood how I apply Gartley pattern to Amazon stock price from a practical standpoint on anticipating the next projected move and how I can trade this stock, betting that it's going to go down, betting that the decline will be about 6%. And if I risk $1,000, expecting a 6% move to the downside, I'll make $60. And you have a statistical edge, a probability of 70 to 80% that this would work out. Let me know. Do you like this format? Will you take this trade? The odds are in your favor. Let me know what you think. And if this format of production and explaining my thought process, my methodologies from a trader perspective makes sense to you. Now, I'll add, this is very short term. This is 1, 2, 3, maybe a week holding period. When you're looking at longer term time horizon, like 3 months, 6 months, a year, you apply fundamental analysis where the probabilities also have to be in your favor, but you're using more research. You're understanding the business, the growth, the margins, the product and service, the value proposition of that company to their consumers, and what can the stock return be in a lengthier amount of time. The duration, the period of length of holding, it's much greater. So let me know what you think, guys. Okay? Take care. Thanks.